We have a special guest today, Thomas Hayes. He's the chairman and managing member of Great Hill Capital. Tom, welcome to Bloomberg HD.
Thanks for having me, Ali.
Fed expects at least 3 interest rate cuts in 2024. So what's your expectation for next year? What kind of actions or steps will Fed take? Your overall observation and feedback.
Yeah, I think there's a wide spread right now between what the Fed expects they'll have to do in cuts, as you referenced on the dot plot, around 3 cuts, versus what the market expects the Fed will have to do, which is around 6 cuts. You know, right now they're highly restrictive. If you look at the Fed funds rate at 525, 550, minus the core rate of inflation, they're probably 200 basis points too restrictive. So I think they'll have to come down probably less than the market thinks, but more than they think is a reasonable assumption, working assumption moving forward.
As you know, Tom, there's a big discussion on recession, a lot of discussions this year. So do you think right now we are not going to see any recession next year? What does the U.S. macroeconomic outlook look like for 2024?
Yeah, well, I think so many people spent 2023 waiting for the recession that already happened in 2022. If you remember, the first quarter and the second quarter of 2022 were negative GDP prints. You had a tech spend recession, and then you had some rolling recessions with manufacturing and other sectors over the last 24 months. So I think that's now largely in the rearview mirror. I think as we look at earnings growth going into 2024, which is what the stock market trades on, we have 12% earnings growth. But the real magic and the real story that very few people are focused on is because everyone was preparing for a recession that never came, they cut a lot of costs and started to run their businesses more efficiently. And I think the real story for 2024 is going to be margin re-acceleration of 60 to 70 basis points, which is going to take everyone by surprise with increased productivity, increased technology, lower costs, and an economy that is starting to recover. So despite the fact that we've moved a long way in a short period of time for the general indices in the last handful of weeks, you have to keep in mind that largely for the S&P 500, the returns since 2021 have been 0. So just now breaking out to new highs, I think there is some runway in 2024 and beyond.
And Tom, when we look at Middle East right now, there is a lot of going on. Do you think the geopolitical developments, especially in the oil industry and gas, would have impact on U.S. economy next year?
Well, there's always geopolitical risk. I do think they are slightly elevated at this point in time. And I think that's probably why the Fed will have to cut less than the market thinks, but more than they think. I do think you could probably start to see a bid in oil as we get towards the end of the first quarter and into the second quarter. And that's going to keep inflation probably slightly above trend and maybe not moving down as aggressively fast as the 6 cuts are pricing in the Fed funds futures. And as a result, the Fed will in fact just be able to do 3 or 4 at the most. But by and large, the geopolitical risk is always present, but it's not going to impact the amount of generators that Generac sells, or the amount of total volume processing that PayPal does, or the amount of new cell towers that Crown Castle does. I think that's a regional conflict that may create short-term volatility for the energy markets at certain points throughout the year, but by and large should remain relatively contained.
And Tom, when I look at past 6 weeks right now, Dow Jones, S&P 500, the stock was doing really good. So what is the stock market outlook for next year, your expectations?
Yeah, so many people are now calling for a correction because we moved too far too fast. I wouldn't get too cute with that because, again, we've been consolidating sideways for 2 years. And secondly, as you look at a presidential election year, there's going to be a lot of fiscal spending coming into the market. On average, since 1928, the average returns for the S&P in an election year are just over 11%, 11.28% on average. And in a year that a sitting president is running for re-election, they're closer to 13%. So we're looking for high single-digit, low double-digit gains in the general indices, which implies that large caps will do less well than they did in 2023, but still do okay. Think the Magnificent Seven. And the opportunity is going to be in the relative value, small caps and mid caps trading at 14 times next year's earnings versus the large caps and the indices trading at 20 times. I think you got to be selective, and I think there'll be great opportunities under the surface to take advantage of.
Is there any specific industry stocks for next year that maybe rising a star, especially when we look at the technology stocks?
Yeah, I mean, as far as technology, we like the fintech area. We like PayPal. This stock has been beaten down 85% off of its 2021 highs. They have a new CEO in Alex Chriss, who came from Intuit. During his tenure there, he was responsible for 50% of the revenues. The stock was a 35 bagger, which means if you had put in $1 million, it became 35 million. He's come to PayPal to turn the company around with the same strategies, and he's going to turn it back into a growth company from a value company. It's currently trading at 12 times earnings. It's historically traded at 30 times. I think as rates come down and as margins go up for the Braintree division, which is the global enterprise processing business, the stock is going to get re-rated. You're going to get multiple expansion. That can be up 50% plus. We also like Cooper Standard is a major holding for us. They do the sealing systems around the windows and doors, the rubber sealing systems, fluid transfer systems, fuel delivery. They provide parts to the original equipment manufacturers, think GM, Ford, etc. And I think as rates come down, you're going to see a reacceleration of people wanting new cars versus used cars, because used cars, the rates are still elevated, and the average car on the road is 13.5 years. So they're just slowly getting back, trying to work towards pre-pandemic volumes. Probably another 12 to 24 months to get up to those levels, but the operating leverage in an OEM supplier like Cooper Standard can be phenomenal, and we think they're going to benefit immensely, despite the fact they've moved up considerably since we've gotten into the stock. We think it can move up even more over the next 12 to 24 months.
And I want to come to the crypto stocks, Tom, especially in the United States, and White House made some statements. They want also action, especially from the US Congress, have a strict regulations on the crypto business. So what is your expectation? How would impact on stocks when you look at some crypto stocks?
Yeah, we don't traffic in crypto stocks. We tend to focus on productive assets that generate free cash flow. But generally, the bullish narrative from the crypto community is that they're going to have a halving. And every time they have a halving, which reduces supply or makes it more expensive to produce it, historically, the coins have gone up in value. And there's expectation that there may be an ETF, which would give access to a lot more people, in which case you should see continued demand. But that's not an area that we play in, despite the fact that it could continue to perform potentially. And a lower rate environment generally helps all risk assets, and that would include crypto. But again, not a space that we play.
Credit conditions seem good, but it seems like it won't continue given the higher interest rate. What do you assess on the corporate credit conditions for next year?
Yeah, it's very interesting what a difference a year makes. Fall of 2022, there was real default risk, particularly in the high yield companies that were trying to refinance their debt. Now, with the expectation of the Fed getting out of the way and starting to ease in 2024, you are seeing spreads come in. You're seeing companies' ability to refinance their debt expand. And I think the theme for 2024 that no one's really paying attention to in their models is not only are companies going to be able to refinance and remove solvency risk, but they're going to be able to refinance at lower rates, which is going to increase the earnings power moving forward. So I think that this is an underestimated tailwind for markets, for earnings, and for companies in 2024 and beyond. The ability to get access to capital in the credit markets and to get it at lower costs will be a boon for the market.
Mm-hmm. And what is your 2024 message to the business world, Tom? This is my last question.
Yeah, I think the message is there's reason to be optimistic. We expect high single-digit, low double-digit returns in the S&P 500, but there are tremendous opportunities from the vast majority of companies in the S&P 500 that are not the Magnificent Seven that have really just begun to participate in the rally and started to come off very, very low valuations. So I think that while the general indices will be subdued, there will be a tremendous amount of opportunity to make money in 2024 and beyond by selecting the right businesses on a case-by-case basis.
Tom, thank you for your time, and Happy New Year to you.
Thank you. Happy New Year, Ali.